Hey everybody, Jeff Garber, mortgage expert. I wanted to give you an interest rate update based on the fact that the Federal Reserve met yesterday. They raised short-term rates by 3/4 of a point, which was expected. This again happened on September 21st. So all of that was what we expected. However, the policy statement and press conference after, based on what the Fed chair had said, did not go well with the market. So the stock market's not doing well today, and neither is the bond market. Well, 30-year fixed mortgage rates, mortgage rates in general live and come from the bond market. And typically, every Fed meeting we've had this year, typically when the Fed hikes short-term rates, bond market typically likes that and mortgage rates come down. And that didn't happen this time. And it didn't happen because the bond market knows that this Fed is losing control. Based on what they said yesterday, they have not convinced the bond market that they have control over getting inflation to come down. And until we start to see inflation come down, or we believe that the Federal Reserve is doing the right things to get inflation to come down, you're going to see the markets continue to sell off. Inflation is the kryptonite to pretty much everything, especially the bond market. So throughout the year, we've known that this has been a rising rate market this year, but the prior Fed hikes have actually caused a reversal where mortgage rates started to come back down again. And during those pockets, we were able to lock in our clients at better rates. It basically stopped the uptrend in mortgage rates for a little while. But since August 1st, inflation's really taken over in the news. The consumer price index, which measures inflation, is coming in higher. The PCE, which also measures inflation, has been coming in higher. And the markets are watching these numbers closely, and that's what they're reacting to. We're all counting on the Federal Reserve to get their act together because their number one job is to make sure we don't have high inflation. That is their number one job. And they missed the mark on it from day one, and now they're playing catch up. And until they play catch up enough to see results, the markets aren't buying it. So we're probably going to continue to see this uptrend in rates. And again, until we start to see some lower inflation numbers, that's pretty much going to be the pattern for a while. So what do we think? Well, we think that by the end of Q4, that all of these Fed hikes that have happened this year will slow the economy enough down to see inflation at least start to subside. And that will be a good thing. And once that happens, heading into 2023, if we continue to get inflation to come down and the Federal Reserve decides to stop with their hikes, well, the markets are going to like that and react. In fact, what would be even better is if the Federal Reserve started cutting rates at some point next year to start stimulating the economy. And at the same time, what we'd see is inflation coming down, but then we start to re-stimulate the economy, and then we get that equilibrium of where it should be. All right, the Federal Reserve, it's a big pendulum. They go too far in one direction all the time, and that's what creates these booms and busts. It's kind of like when you get in the shower every morning and you turn the water on and it's cold. What do? You grab that handle, you turn it all the way to hot. But if you walked in the shower at that point, you'd burn yourself because it's too hot. So what do? We dial it back and we get that to the temperature that we want. Well, the Federal Reserve does that, but what they do is they go hot all the way, then they go all the way to the other direction, cold, and then all the way to the other direction, hot, right? They never seem to get it just right. And that's why we have booms and busts because of this. So that's what we're in now. We're in a phase where the Fed is hiking aggressively, and they're probably going to hike too much. They're going to burn us and burn the economy. All right. We need to get through that. We need to get to the point where they stop hiking and maybe start cutting rates and finding that equilibrium and getting us back into a market that we want. So that's kind of what we see in the short run here. Now knowing that rates are going up, that creates an affordability issue for all of us that are looking to buy and all of us that work in real estate, from the lending side and from real estate side. This is no fun. It is, and consumers can see it. Rates are going up, but there are affordability strategies in this market that are worth talking about, right? We have adjustable rate mortgages that we can use to try and keep rates a little bit lower and keep the payment more affordable. We also have what's called a 2-1 buy down strategy. Okay. And this is a little bit more complicated to explain in a video like this, but we have a strategy where we can offer a lower rate for year one, and then a little bit higher of a rate for year two. And then from year 3 through year 30, it goes back to the rate that you would have had if you locked that day. It is not an adjustable rate mortgage. There is nothing at all fishy behind it. It's a good strategy, but it takes a little bit of education to understand it. And if you have any questions on that, you can reach out to me. Again, it's called the 2-1 buy down. It's becoming a very good strategy. The higher mortgage rates go, the better the strategies are of looking into 2-1 buy downs and looking into adjustable rate mortgages. But at the end of the day, we do know that these high rates will create a refi boom at some point in time. In other words, you won't have this mortgage or this rate for the full 30 years. So, as we've been saying all year, you definitely want to marry the house and date the rate. Okay. So, find the house that you're looking for that's going to meet your needs. Get in with an affordable payment, hopefully, whatever the rate is, it is. But at some point in time, rates are going to come down, and we're going to look to do refinancing to all of the people that are in the higher rates, get them down to a lower rate and a more manageable payment. All right. I hope this helps. Please reach out to me if you have any questions, and I will be following inflation and putting out more information to keep you up to date. Have a good one.